For decades, companies had this, well, gigantic loophole in their financial reporting. Think about airlines leasing jets, retail chains leasing stores, companies leasing whole vehicle fleets.
Yeah, massive obligations.
Huge commitments worth billions, often basically hidden unless you really dug into the footnotes.
That's right. And that whole era of, let's call it, off-balance sheet financing, it largely ended with standards like IFRS 16.
Right.
So our mission in this deep dive is really to cut through the technical jargon.
Yeah, get to the point.
Exactly. To quickly understand the fundamental shift, how almost every lease from the user side now hits the balance sheet, moves those hidden decks right out into the open.
So if you're looking at any big company's balance sheet today, you really need to get where these new assets and liabilities are coming from.
Absolutely.
We'll cover three main things. First, what is a lease now? Second, the mechanics, sometimes tricky, of measuring these right-of-use assets and the debt. And finally, we'll look at the exceptions and some more advanced stuff like sale and leaseback deals. Those can be mind-bending.
They really can be. And it's a truly revolutionary change in reporting. It's what lets you properly compare a company that buys its assets versus one that leases everything.
Okay, let's start with the basics then, the core definition. What are we actually talking about?
Well, at its simplest, a lease is just a contract. It gives the right to control the use of some specific asset for a period of time.
And you pay for it.
And you pay for it, yes. Consideration. The standards focus really heavily on that right to control the use part.
Okay, so who are the players involved?
You've got the lessor, that's the owner, the entity providing the asset, think the bank or the property owner.
Right.
And then you have the lessee, that's the company getting the right to use the asset. They're the focus for us today.
And what the lessee gets, that's the key new thing on the balance sheet, right?
Yeah.
The right-of-use asset, ROU asset.
Precisely. That ROU asset, it's really the centerpiece of these new rules. It represents the lessee's economic rights to use that asset over the agreement.
Which brings us to the fundamental principle, the big change. Under IFR 16, when the lease starts, the lessee has to record both things.
Yeah.
A lease liability, the debt, and that ROU asset.
That's it. It's not just an operating expense anymore. It's treated almost like you finance the purchase of the right to use the asset itself.
Okay.
And because you have to capitalize it, well, that means we need to get really precise about measuring that liability, which leads to the next challenge.
Yeah, speaking of complexity, let's dive into measuring that debt. It's not just adding up all the payments, is it? Because of, time value of money.
Correct. The initial measurement of the liability is the present value, the PV, of all the lease payments you haven't paid yet.
Okay.
And this is where it gets, well, technical. You need to know exactly what counts as a lease payment.
Okay, so it includes the obvious stuff, like fixed monthly payments.
Right.
But what else gets thrown in?
Right. So you also have to include amounts you expect to pay under any residual value guarantees.
Okay, like guaranteeing the asset's worth something at the end.
Exactly. If you promise the lessor it will be worth at least, say, $50,000, and you expect it might only be worth $40,000, that $10,000 difference, that expected payout is part of your liability now.
Wow, okay. What else?
You also need to factor in payments for options to buy the asset, but only if it's reasonably certain you'll exercise that option. That takes some judgment.
Reasonably certain. That sounds subjective.
It is. And same for termination penalties. You only include those if the way you've determined the lease term implies you will actually incur those penalties. The key here is substance over form. What's the company realistically going to have to pay, regardless of the exact contract wording?
Okay, so to get that present value, you need a discount rate. And picking that rate seems like it could massively swing the final numbers on the balance sheet.
Oh, it absolutely does. The first choice, the required choice, if you can figure it out, is the rate implicit in the lease.
Which is?
That's the rate that basically makes the present value of all the payments plus any unguaranteed residual value equal the fair value of the asset plus the lessor's initial direct costs. It's complicated.
And often not known by the lessee.
Often not easily determinable, yes. The lessee might not have all that info.
So if they can't figure that out,
then they default to the lessee's incremental borrowing rate.
Meaning,
what rate would that specific company have to pay to borrow funds for a similar amount over a similar term with similar security?
Right.
We saw an example in the source material. A company called Dynamic used 5% because they just couldn't determine the implicit rate. That shift from, say, 4% implicit to 5% incremental, that can change the PV liability by millions. It's critical.
And even before you calculate the PV, you have to figure out the lease term. This sounds like another area where judgment really impacts the financials.
Huge impact because the term isn't just the fixed, non-cancelable period in the contract. You also have to include periods covered by any extension options, but again, only if the lessee is reasonably certain to exercise them.
Let's use that dynamic example again. Their contract was just for 2 years initially, right?
Correct. 2 years non-cancelable. But they had an option for a third year.
Well,
And because their business plans, their strategy, made taking that third year highly likely it met the reasonably certain threshold, the actual lease term for accounting purposes became 3 years, not 2.
wow. So just like that, an extra year of debt liability and an extra year of ROU asset depreciation hit their books.
Exactly. The rules force the financials to show the economic reality of the commitment, not just the minimum legal obligation on paper.
Okay, liability measured, term decided. Let's flip to the other side, the right of use asset. We know it starts with that liability amount,
Okay.
but what else gets added to the initial cost?
Yeah, think of it like buying any other asset. You capitalize costs needed to get it ready for use. So number one, it starts with that initial lease liability figure we just calculated. Then you add any lease payments made before or at the commencement date. Upfront payments, basically.
Got it.
Next, add any initial direct costs, things like broker fees, legal costs to set up the lease. That example we saw mentioned adding $3,000 for this.
Okay.
And finally, you have to add the estimated future cost to dismantle or remove the asset at the end, if that's an obligation, like site restoration costs.
That seems like quite a few additions. Does anything reduce the ROU asset cost?
Yes, one important deduction. Any lease incentive payments received from the lessor, maybe they gave you some cash up front to sign the lease, you subtract that.
Okay, so liability plus upfront payments plus direct costs plus dismantling costs incentives, initial ROU asset cost.
That's the calculation. That final net figure is your starting point for the asset.
Right, so we've got the asset and debt on the books day one. What happens year after year? The ongoing accounting.
Okay, for the liability, it behaves much like a standard loan or mortgage amortization. Well, each year, the liability balance increases by the imputed interest charge. That interest amount flows to the profit and loss statement as interest expense.
Right, which is different from before when it might have just been one single rent expense.
Exactly. Now it's split. Interest expense and then depreciation on the asset side.
Okay, so liability goes up by interest.
And it goes down whenever you make a cash lease payment.
Standard loan repayment then.
Pretty much. And this is also where you see the split between current and non-current liabilities on the balance sheet.
Right.
The portion of that outstanding liability balance that's due within the next 12 months, that's your current liability. The rest is non-current. Standard practice.
Makes sense. Now, what about the ROU asset side? How does its value decrease over time?
Okay. The ROU asset is typically depreciated using the cost model, just like property, plant, and equipment. Straight line is common.
Over what period?
Here's the key rule. Depreciation happens over the shorter of the asset's useful life and the lease term we determined earlier.
Shorter. Why shorter?
Because your right to use the asset only lasts for the lease term, even if the asset itself could last longer. If it's a 10-year asset but you only lease it for 5 years, you need to expense your use of it over those 5 years.
Okay, that makes sense. But you mentioned an exception involving ownership.
Yes, a crucial one. If the lease includes terms meaning ownership of the asset transfers to the lessee by the end of the lease term, maybe through a bargain purchase option, then that shorter of rule doesn't apply.
So what happens then?
In that case, you depreciate the ROU asset over the asset's entire useful life.
Because you expect to control and benefit from it for its full economic life, not just the initial lease period.
Precisely. You're effectively going to own it. Now, the source material had that slightly confusing example.
Right, the computer. 7-year useful life, 2-year lease, but ownership transfers. The text said depreciate over 3 years.
Yeah, that specific example seems a bit odd in its wording, maybe implying a revised useful life assessment upon transfer. But the principle is clear. If ownership transfers, depreciate over the expected period of use, which is generally the asset's useful life, overriding the shorter lease term.
Okay, the takeaway is ownership transfer means depreciate over the longer useful life, not the lease term.
Got it. Use the full period of expected control.
All right, that's a lot of detail. Before we tackle the really complex stuff, let's talk about the escape hatches, the simplified accounting. When can companies avoid all this capitalization?
Right. There are two helpful exemptions in IFRS 16. If a lease qualifies, the payments are just treated as an expense, usually straight line. No ROU asset, no liability. Much simpler.
Okay, first one.
Short-term leases. Pretty straightforward.
How short is short term?
12 months or less, measured from the start date of the lease.
Simple enough. And the second exemption.
Low-value assets. This one needs a bit more judgment.
Is there a guideline?
Yes, the standard suggests a threshold around $5,000 as a guide, assessed for the individual underlying asset.
Okay, $5,000. What kind of things typically fall into this?
The standard gives examples like tablets, small personal computers, office telephones, small ideas of furniture, things that are individually, well, low value.
What about, say, leasing a really old, cheap car? Does that count as low value?
Ah, good question. No, probably not. That's a key point. The assessment is based on the value of the asset when it was new.
Ah,
So a car, even an old beat-up one you're leasing cheap, was likely not a low-value asset when it was new. Therefore, you generally can't use the exemption. You'd still have to capitalize that lease.
that's a really important distinction, value and new.
Got it.
Okay, let's shift gears to the deep end. Sale and leaseback transactions.
Yeah.
These combine IFRS 16 with the revenue standard, IFRS 15.
Right. This is where a company sells an asset, maybe its headquarters or a factory, to another party, like an investor or a bank.
And immediately leases it right back.
Exactly. They get a chunk of cash up front from the sale, but continue using the asset just like before under the new lease.
Sounds a bit like taking out a mortgage, but calling it a sale to maybe book a profit.
That's precisely the potential issue this standard addresses. So the very first critical step is to determine, does this transfer actually qualify as a sale under IFRS 15 rules?
Meaning, did control really transfer to the buyer lessor?
Yes, that's the hurdle. Has the seller truly given up control consistent with a sale?
Okay, let's say it does qualify as a sale. Control transferred. Now, the original owner is both a seller and a lessee. How does that work? They can't recognize the full gain on sale, right?
Correct. This is where it gets intricate. The seller lessee can only recognize profit or loss related to the rights they actually transferred to the buyer lessor.
So not the portion they're keeping use of through the leaseback.
Exactly. You can't book a profit on the part of the asset you're essentially still controlling and using via the lease.
So how do they calculate the ROU asset then to reflect only the rights they kept?
There's a specific formula. They measure the ROU asset as a proportion of the asset's previous carrying amount before the sale.
Okay, what's the formula?
You take the initial lease liability figure, calculated using the PV method we discussed, divide that by the total sale proceeds received, and then multiply that fraction by the asset's previous carrying amount.
Huh. So lease liability sale proceeds times the old book value. What does that fraction represent?
It basically represents the proportion of the asset's value that relates to the right of use retained by the seller lessee via the leaseback.
Ah, I see. So you're only capitalizing the ROU asset based on the slice of the original asset you effectively kept control over.
Precisely. It stops companies from artificially boosting their balance sheet and income by selling an asset they immediately lease back. The profit recognized is only on the part truly given up.
Okay, that makes sense. It prevents some financial engineering. Now, what if the transaction fails the IFRS 15 test? What if it's not deemed a sale?
Well, that's much simpler from an accounting perspective, though maybe less desirable for the company wanting cash and profit.
How so?
If it doesn't qualify as a sale, the whole thing is treated essentially as secured financing, a loan.
So the asset stays on the seller lessee's books?
Yes, the seller lessee continues to recognize the asset as if the transfer never happened. And the cash they receive from the buyer lessor, that's recorded simply as a financial liability, like a loan collateralized by the asset.
So no sale recognized, no gain recognized, just more debt.
Correct. It's a stark difference. One path treats it as a partial sale and a leaseback, potentially recognizing some profit. The other treats it purely as borrowing money. Which path you take depends entirely on whether that initial transfer met the IFRS 15 sale criteria.
Fascinating. Precision is definitely key in that area.
It really is a very complex corner of reporting.
Well, this has been incredibly insightful, a real deep dive. So bringing it all together, the big takeaway is the mandatory recognition of both an asset and a liability for pretty much every lease now. We saw how critical judgment is in figuring out the lease term and picking the discount rate, which directly impacts those balance sheet numbers.
Absolutely. And we covered the practical exemptions for small stuff and then unpacked the real complexities of sale and leaseback accounting, forcing companies to be, well, more transparent about the substance of those deals.
Right.
And fundamentally, these rules came about for one big reason: transparency. Shifting those massive operating commitments from the footnotes, where they were kind of hidden, squarely onto the balance sheet as actual debt.
So the big question for you listening to this, maybe as an investor or analyst looking at company financials, here's something to chew on.
Mm-hmm.
If a huge retailer or an airline suddenly has to capitalize all its store or aircraft leases, drastically increasing both its reported assets and its reported debt, how much does that really change your perception of its risk profile compared to before?
That's the million-dollar question, isn't it? The economic obligation, the debt, was arguably always there. It was just reported differently.
Right.
So does simply changing where you report the debt, moving it from footnote C to line item 12 on the balance sheet, fundamentally alter the underlying business risk? Or does it just confirm what savvy analysts probably factored in already? That's the ongoing debate these rules really spark.